In the world of finance, there is a silent killer. It's more dangerous than a market crash, more deceptive than a scam, and more powerful than any mathematical model. It's called FOMO, the fear of missing out. You've felt it. You're sitting at your desk and you see a notification. Some company or crypto project you never heard of is up 400%. You check Twitter and everyone is posting screenshots of their easy gains. You feel a physical tightness in your chest. You feel like the world is moving forward, getting rich, and leaving you behind in the dust of mediocrity. In that moment, your rational brain, the part that understands math, risk, and logic, is hijacked. You aren't an investor anymore. You are a prey animal trying to keep up with the herd. Today, we are going to deconstruct the FOMO factor. We're going to look at why your biology is working against you, the historical bubbles that ruined even the smartest men in history, and how modern apps are designed like casinos to keep you in a state of perpetual panic. To beat FOMO, you have to realize it isn't a character flaw. It's a survival mechanism that is as old as time itself. In our ancestral past, being left out of the tribe meant certain death. If the tribe found a new source of food and you didn't follow, you starved. If they moved to a safer valley and you stayed behind, you were eaten. Our brains developed a high-priority alarm system for social exclusion. When you see a green candle on a chart, your amygdala, the brain's fear center, triggers a shot of cortisol. Your body treats a rising stock price like a migrating herd of buffalo. You feel that you must run with them or lose your chance at survival. But there's a second chemical at play: dopamine. Dopamine isn't about pleasure, it's about anticipation. The moment before you click buy on a hype train asset, your brain is flooded with dopamine. You are imagining the life you'll have when it goes up another 10x. You are literally high on the potential of the trade. This combination, the fear of cortisol and the high of dopamine, creates a state called annuity neglect. You stop seeing the long-term risk and only see the immediate social pain of being left out. If you think you're too smart for FOMO, let's talk about Sir Isaac Newton, the man who discovered gravity, invented calculus, and mastered the laws of the universe. In 1720, England was gripped by the South Sea bubble. A company had a monopoly on trade with South America. Everyone was getting rich. Newton initially invested, made a 100% profit, and sold his shares. He was happy. But the price kept going up. He watched his friends, who weren't nearly as smart as him, continue to make massive fortunes. The social pain became too much. Newton couldn't stand it. He jumped back in at the absolute top with his life savings. The bubble burst. Newton lost nearly everything. He famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." The lesson here is profound. IQ is no protection against FOMO. In fact, high IQ people are often more susceptible because they believe they can outthink the crowd or time the exit perfectly. The market doesn't care how smart you are. It only cares about the supply and demand of the herd. In the last decade, FOMO has been weaponized. We have moved from the South Sea bubble to the smartphone bubble. Have you ever wondered why trading apps use bright colors? Why there's confetti when you make a trade and they send you push notifications when a stock is trending? This is variable reward architecture. It's the same technology used in slot machines. If you knew exactly when you would win, you'd get bored. But because you might miss a win, you check the app 50 times a day. We are living through what I call UI/UX debasement. The interface of our financial lives has been designed to bypass our prefrontal cortex. These apps don't want you to be a value investor. They want you to be a frequency trader. The more you trade, driven by the FOMO of trending tickers, the more the house wins in fees, spreads, and data selling. Let's look at the math, because the math is the only thing that doesn't lie. In the world of finance, FOMO is essentially a tax on the latecomer. It usually peaks at the point of maximum financial risk, right when the smart money is looking for an exit. To understand why this is so dangerous, we have to look at the percentage paradox. Imagine you see an asset, let's call it Hype Corp, at $10. You ignore it. It goes to $20. You're interested, but cautious. It hits $50, and suddenly your social media feed is exploding. Can't take it anymore. So you buy at $100, because everyone knows it's going to $200. But here's the brutal reality of math. If you buy at $100 and it drops back to $50, you have lost 50% of your money. But to get back to your starting point of $100, That asset now has to go up 100%. The further you fall, the harder the climb. A 75% drop requires a 300% gain just to break even. A 90% drop? You need a 900% gain just to see your original dollar again. When you buy at the peak of a FOMO cycle, you are mathematically putting yourself in a hole that most investors never climb out of. Look at Cisco Systems in the year 2000. It was the backbone of the internet. Everyone had FOMO. If you didn't own Cisco, you couldn't call yourself an investor. The price hit an all-time high of about $80. If you bought then, you were buying into a sure thing. Then the bubble burst. Cisco dropped nearly 90%. It took over 20 years for the price to even get close to those highs again. That is the true cost of FOMO. It's not just the money you lose, it's the time you lose. You spent 2 decades just trying to get your buy-in back while the rest of the world moved on. Another great example was the 2021 crypto altcoin mania. New coins were launching every day. People were looking at charts that went straight up, and our lizard brains were screaming at us to buy. But look at the volume. In almost every FOMO cycle, the highest trading volume happens at the highest price. This is the transfer of wealth. The last buyer is the person who provides the liquidity for the early buyer to exit. When you buy because of FOMO, you aren't investing in a technology or a company. You are volunteering to be the exit strategy for someone who is smarter and earlier than you. You are the exit liquidity. Use the RSI warning signal if you want a mathematical tool to fight FOMO. Look at the RSI Relative Strength Index. This is a momentum oscillator that measures the speed and change of price movements. When the RSI goes above 70, the asset is overbought. This is the red zone. Mathematically, it means the price has moved too far, too fast. When your brain is screaming buy because of the hype, the RSI is often screaming danger, because the math is overextended. Professional traders wait for the RSI to cool down. FOMO traders buy right when the RSI is at 90, effectively jumping into a burning building because they saw someone else walk out with a gold bar. Chasing a pump is like picking up pennies in front of a steamroller. You might get a few cents, but if you're a second too late, you're crushed. The debasement trade we talked about in a previous video requires patience. FOMO is the opposite of patience. It is the desire for instant wealth, which is the fastest way to instant poverty. So, how do you kill the FOMO factor? You embrace JOMO, the joy of missing out. Professional traders don't try to catch every move. They have a system. If a trade doesn't fit their system, they are happy to miss it. They watch a 400% pump and feel nothing because that move wasn't theirs to take. The cure for FOMO is focus. It's having a plan so solid that the noise of the crowd doesn't reach your ears. Let's hear your stories in the comments. What was the one time FOMO got the better of you? What did you buy at the top, and what did you learn from it? We've all been there, even Isaac Newton. Let's talk about how we can build better systems to protect our capital. Don't forget to like and subscribe if this video helped you understand your own lizard brain a bit better. Don't miss the next video on how buying low and selling high is almost impossible, and I'll see you in the next one.